Welcome to our next session and our last section before lunch, Perspectives from the Federal Reserve. I'm Jeremy Grant, Managing Director at Venable. Thrilled to be joined by Chris Schnieper, who's the Director of Secure Payments at the Federal Reserve's Financial Services. Chris and I said we were going to set this up as a fireside chat, so I brought the fire. Hopefully it makes you feel a little warm and toasty. I know it's a little chilly in here, just in a t-shirt. So rather than go through a bunch of slides, we're really just going to do this as a conversation, and hopefully that makes things a little bit more lively. I want to get started, Chris. Can you give us an introduction to the Federal Reserve? I think most people know it as the group that sets interest rates, which, by the way, it's lovely to see them coming down again. But they might not be aware of the other roles that the Fed plays. Why are they sending somebody to an authentication conference?
Sure. No, thank you. And certainly appreciate the invitation to come here from Authenticate, and very much appreciate all of you folks attending the session today. Just as a quick disclaimer, my comments are those of my own and may not necessarily be the same as the Federal Reserve. So just a quick civics lesson. The Federal Reserve System actually is comprised of three separate entities: the Federal Reserve Board, the Open Market Committee, and then the Federal Reserve Banks. I'm in the Federal Reserve Banks portion of that. Now, while certainly the Federal Reserve Banks do have supervisory role and activity through the board, I'm in a group called FRFS, which is the Federal Reserve Financial Services Group. And if you were to actually look at the day in the life of somebody in FRFS, it would look very much like any other non-depository bank that sells products or services. We have got a product team, a fraud team. We have we've got folks that sell services. We've got technology group and so forth. So we would look at very similar, and those would be services like check, cash, ACH. A lot of you folks are probably very familiar with those services. Within that umbrella group, and that umbrella group grows across all 12 banks. So we've got participants from all the different districts that work under that organization. Within that, there's a group called Payments Improvement, which I'm part of. And I want to say that's probably 5 or 6 years that it's been around. I've only been with the bank about 6 months now, but that group has been around for a number of years. And what we try to focus on is either helping to facilitate conversations amongst banks, advocacy groups, industry partners, vendors, to really help understand difficult topics, and either to create content to help educate the broader payments and financial services organizations, or to help facilitate work groups. One example of that would be the scams class. We did something called a fraud classifier about 3 years ago, and then we recently published something called the scams classifier. So we're certainly very interested in topics around fraud, how to control fraud, and then how do we help look at difficult topics to help facilitate that dialogue in the marketplace.
All right, thanks. And how did you get to the Fed? What brought you there?
Sure. So working for the Fed has actually always been a career goal of mine. I was, in fact, when I was very young and didn't understand really what a paycheck meant, I actually moved out to San Francisco to go to graduate school because I figured, I'll just work for the Fed, right? I mean, they're super cool. And then I realized that that life happens, and one thing led to another. And I worked for a number of financial services institutions, Accenture, worked for Early Warning at one point, LexisNexis, kind of all around. And then I was on the scams work group, and a job opened up, and I said, "Yep, this is my opportunity." Really love the group that facilitated it. It's a small, very experienced group of folks, and felt right at home in that environment.
Nice. So you mentioned scams. We're at an authentication conference, but there's a lot of focus on scams in financial services these days. Hearing it from banking, hearing it from fintechs. A lot of other trade groups are starting to focus on it because things aren't great right now. What can you tell us about some of what you're seeing today from your post and where authentication's playing a role?
Sure. So certainly scams is an enormous and enduring challenge right now. Not only in financial services, but across the board. And a lot of it really is around this notion that we probably have, the industry probably has really, really good tools around ATO, even though there's always room for improvement. But certainly this notion that, as all of you are probably painfully aware, that you go after the individual and you convince the individual. So certainly when one looks at either the IC3, FTC, different type of sources, certainly the investment type of scams seem to be really exploding. Very much we're seeing imposter scams, including romance scams, and that's something we thought about in terms of the scam classifier when we put that together. One thing that we thought about was, well, we need to have a definition. And then we want to break it up so it was consistent with the fraud classifier, as well as there'd be a mechanism by which we could contemplate things like, is it authorized or unauthorized? What category? Is it a product? Is it a service? And then have actual ways of being able to classify that at a more discrete level in order for when either organizations internally or externally are communicating the type of scam it is, that there's a consistent vernacular across that.
And so how do banks use that? I assume just having a shared terminology, standard definitions, enables them to communicate better with each other as well as with, their partners in government?
That's right. In fact, we, one of the elements that we ask is that when organizations communicate, as an example, fraud back to us, that they utilize the fraud classifier to communicate the type of fraud. Because the scam classifier is so new, we're still in the process of publishing, educating, getting that disseminated amongst organizations. And then the goal is, is there a way we can utilize that? There is actually also a tangential work group called the info sharing group. And in the info sharing group, it was really about how can we help facilitate a general payments and financial services dialogue around how and what would be appropriate to share. And obviously, we've talked about this. There are a number of challenges with how detailed data, but at bare minimum, being able to communicate this is an authorized scam, and it's authorized romance scam, and that way at least organizations can have a consistent or normalized way of communicating that.
Got it. And in terms of tracking, so you have I don't think I'd call it a sister agency, but another, agency in government, which is FinCEN, the Treasury Department's Financial Crimes Enforcement Network, started doing something really interesting over the last year, which is looking at all the suspicious activity reports that banks file when they see something that, as the name would suggest, looks suspicious, and actually starting to classify them by what made them suspicious or what was going wrong, and really focusing a lot on identity. And the numbers, they released this back in January, the numbers were pretty stunning. They said looking at the SARS in 2021, 42% of all of them were tied to some compromised identity, tying to about $212 billion in transactions. And then breaking it down a little bit more, they look specifically at those tied to credential compromise. That was $112 billion, which that's a lot of money. Wondering if this aligns with what you're seeing in terms of scam or other attacks trends, in terms of things that you guys are tracking from your post, and are there any takeaways we should have from that?
It certainly does track. I think it also depends on because there are a number of different groups that collect the data. That it is somewhat dependent on who, when, and how they're communicating that data, but certainly it is very consistent, and certainly the concern around scams, how to identify and then mitigate the scam is certainly an ongoing challenge that many organizations are having.
Yeah. So as you think about some of the tools that are out there that financial institutions should be using to help detect scams, what are some of the things that you are thinking about these days?
Sure. No, that's a great question. there are a couple things, and I think, and I've heard this in a number of speakers this week, and it's truly, there is no one size fits all. It's very difficult to say, hey, if you do this or if you do that, and part of that challenge is this notion of a detect and then attack type of cycle, where you can detect and then they change the go for a different attack surface. They try a different attack vector, and then you defend against that and create policies or put tools in, and certainly that will be a continuing effort that organizations need to be concerned with. Certainly, this notion, and we talked very briefly about this earlier, this notion of contemplating a broader set of signals to interrogate. So that would be things like, is it the same device? What type of device? Indirect signals like, what do I see associated with that device? Either from the phone side or from the internet side. And then what do I see on the device? And this could be some type of behavioral biometric type of capability. This could be either an analytic side saying, hey, you know what, this doesn't look like a human, this looks like a bot. Or it could be something where, all of a sudden in the middle of the session, it looks like the interaction is fundamentally different. So maybe somebody has taken over the session versus the actual user. And so it's really looking at, do I have access to a broader set of signals? And then once I do have access to that broader set of signals, then how do I bring that together to say, hey, this looks like it could be a scam? I think that's really part A of the challenge, and part B is the mitigation. If you do it within the transaction, most transactions happen very quickly, how do you reach out to that, to the authorized account holder and say, hey, we think something's going on. Certainly there is this, anecdotally, there is certainly some evidence suggesting that there's a lot of notification fatigue with consumers, and so they'll say, yeah, no, this is me. So is it enough, for a certain message versus a different message? And I think that's where, certainly we'd like to do more research. We'd like to chat with more organizations around what is the right combination of the signals on the detection side, and then what's the appropriate level of interaction, especially in regulated and financial services. This notion of it's always frictionless. I disagree with that. I prefer looking at it from an interaction perspective. I think many, if not most, consumers in financial services make a utility trade-off between convenience and safety. And so if I'm checking the balance of my account, you don't need anything from me. Just if you've seen the device before, we're good. However, if I'm doing a one-time large transaction, I do expect you to interact with me. I do expect you to do something to help maintain that level of safety.
Yeah. And when we talk about shared signals and information sharing, we were talking about this just a little bit before we came up on stage. Right now, I think the financial services industry has, arguably been one of the best when it comes to information sharing. You've got organizations like the FSISAC that exists, but that's more sharing things like cyber threat intelligence. Hey, we're seeing these kind of attacks, and being able to share information across, different financial institutions, and maybe they can trade tips on how to defend. There's a different kind of sharing, which is, hey, we're seeing a specific account that might seem like it has the signs that it's being used for something it shouldn't be using. Maybe it's not in the hands of the person who opened it up, or maybe it was a synthetic, account that's being used for bad purposes. And there it seems like there's a lot of interesting discussions, I think, in a bunch of different circles that we both run in around, and I realize you're not on the regulatory side, but do we have the policy foundation in place that would actually allow institutions to share those kinds of signals? And, is this an area maybe we need to think about more work next year?
Sure. And what's actually very interesting is this notion of, I'll just say, signal, information, data, signal sharing is really nothing new in the marketplace. There are a number of, I'm not, as an individual working for the Fed, I'm not going to name any individual organizations, but there are a number of organizations that do data sharing today. They do signal sharing today, and they have been doing it for decades, some decades, some a decade. So this notion of that type of signal sharing is not necessarily new. I think exactly to your point, I think what's happening now is that you may say, oh, let's say I've done a one-way hash on a set of devices, I throw it into some type of consortium, and then I have access to that consortium, that risk-sharing data, and I can say, oh, I've seen this device 5 times within the last hour. This does not look right. So I'm gonna elevate, and then I'm going to hit them with some type of step-up authentication and say, you know what, Jeremy, I've seen your device way too many times. I'm either gonna shut the transaction down or I'm gonna do something with some level of interaction. I believe what's happening now is that you're saying, okay, cool, I get that there's some risk here, but now I want to go a step further. I want to be able to say, is this the same routing number that I'm seeing on the payee side? Is the same account number I'm seeing? And then, by the way, maybe, can I look at other signals like how many, the payee side organizations, how many phone numbers are associated with that account? How many addresses are associated with that account? How many social security numbers? And all of a sudden, you'll say, hey, this looks really odd. If you do like a graph analytics type of a view of it, you may say, this looks really odd. Now, got to watch out for the edge cases, because what I described could very well be you and I have an architecture organizations, and we take large payments in, we make little payments out, which could be 100% correct. But again, it's more that notion of as the industry and organizations are desiring a greater amount of detail in the info sharing, how do we have that right dialogue with organizations and with regulatory organizations to say, hey, this is something that would be accretive to this scam detection process? Are there different ways we need to contemplate it? And I don't think it's a matter of just, we'll hash everything. I think there has to be, something that there's a good way of having a foundation around that.
Yeah. So we've talked a lot about risk signals and things that can do to augment more traditional authentication. Bringing it back, we're obviously at a FIDO conference, so there's a lot of talk about FIDO authentication in different sectors, including financial services. For folks in the room who are trying to sort of understand the role that your organization is going to play, do you see you all sort of evolving to a point where you're laying out a set of best practices or frameworks to follow, or do you think things are going to continue to be much more around information gathering, sharing best practices, but never actually getting to a point where you're getting, I guess, more specific on things?
So I would say it's probably fairly difficult for us to necessarily publish a quote best practices, mostly because of the breadth and size of the financial services ecosystem. At least, while I keep track of what loosely what happens elsewhere, I'm the 100% of my time is really focused on the U.S. system. I think that there's going to be a broad set of best practices, because what might work for a larger organization may not work for a community bank or a credit union. So we try to stay away from kind of a what I'll call a more narrow set of best practices, and we more try to think about frameworks. And that framework is when we go out and we meet with different size organizations, industry advocates groups, industry partners, what are the set of activities that organizations are saying, hey, we've found this to be successful? And then from there, and an example is we put together a synthetic identity toolkit, right? Which
was great, by the way.
What's that?
It was great.
Yeah, no, thank you. And any of the items I talk about, if you go out to Fed Payments, and that's plural, fedpaymentsimprovement.org, you can find all this. Everything I'm talking about is fully published. There, what we did in that toolkit, what we said was, okay, here are a set of practices that organizations have found successful. And so we did publish that. And we did, I want to say we also had a list of organizations that had said, hey, we do this type of work, which we put up there as well. And we work with different industry organizations around trying to stay up on what are some of the new improving practices that organizations can think about in order to help reduce fraud exposure.
So I know we're coming up. We got about 4 minutes left. I had one last question before we can open up to the audience. And by the way, I'd say for those of you who are virtual, please submit your questions through the app. I've got it open here, and we can ping Chris with them that way. But the attendees here in the room, there's a mix of, there's a lot of banks here, payments companies, fintech firms, also a lot of the vendors that are in the space. How should they think about how to work with your office? Is there an engagement model that you all have that they should be keeping in mind? Understanding you guys probably don't want like a vendor pitch, and you're not buying this stuff. But how does the private sector typically interact with your group at the Fed?
Sure. No. Thank you for that. So a number of different ways. We try to attend a number of different conferences like Authenticate and other either payments or fraud related type of conferences in order to listen to folks, interact with folks. A number of times we do something like this, have a fireside chat, or we make a presentation on our content. Also, we have a number of different type of work groups that we facilitate where we try to rotate individuals on those groups where it'll be a combination of some small banks, medium-sized banks, large banks, industry vendors, advocacy groups, again, to come together. And certainly, whenever folks see myself or somebody from the payment improvement group, we're certainly always happy to listen, to chat about these topics. So, again, always happy to chat.
Great, thanks. Any questions from the audience? We got a couple minutes left. Hello, Bjorn.
Bjorn, Yubico. You mentioned signals, and so the OpenID Foundation has a shared signals framework, and it has really two components. One is what they refer to as risk. So there's signals when there is a change, either account or any attributes related to an account. The other part is the continuous access control. So meaning, have I seen this device, or do I recognize the location, or what have you? So one is more reactive and one is more proactive. So when we reference signals, I'm curious because you gave some examples and I would categorize them as either reactive or proactive. So could you expand when you talk about signals, what if there's reactive, proactive, both, and if so, are you looking at specific standards or organizations to create those specifications?
Sure. No. Thank you for that. So certainly, when I say signal, I very much mean it in a very broad term, and I really it can be a few of those or all of those. So it's certainly where like many organizations, we're interested in what's the broader understanding, not just of groups that have frameworks in place, but also of organizations, like a community bank compared to a middle-sized bank, and what's their understanding? Like, do they even realize there are those type of standards out there? Do they have the budget for something that's a bit more dynamic in nature? And so do they, is it they can use something that's a slightly more static or slightly more not going to be as dynamic simply because of the budget and what they have available to them. So again, when I think about signals, it's very broad, but I do agree that once you start getting into like how and what you can share and when it's appropriate to share, you have to have some type of framework in place to understand exactly what it is you're sharing.
Other questions in the audience? We had one online, which I think is one you can't answer because we talked about it before. You want me to ask it anyway so you can explain?
Sure.
What is the Federal Reserve's view on passkeys?
Yeah, certainly that's, I truly believe that the organizations in the industry will certainly evolve over time. And I think that all institutions are in their unique space in terms of where they are in technology development, ability to implement different solutions. And we certainly encourage any type of innovation or investment into different technologies that are going to be better for consumers, better for costs, and reduce fraud. And so I may personally like certain type of technologies, but from a Fed perspective, I would be, at this point, I wouldn't be able to comment on any individual technology.
All right, got it. Well, we are out of time, and more importantly, it's time for lunch. So we'll convene back here in a little over an hour. Friend Grant Dasher from CISA is going to be our lead presenter in the first session of the afternoon track. So thank you, everybody. Appreciate it.
Thank you.